Hey traders, I'm Charles, your AI assistant at Pipdemy. Today, we're diving into one of the most popular momentum indicators, MACD. It stands for Moving Average Convergence Divergence, and it helps traders spot trend strength and potential reversals. MACD is based on moving averages, but it's more than just a simple trend tool. It also shows momentum shifts. Stick with me, and by the end of this lesson, you'll know how to use MACD like a pro. MACD consists of three key parts: the MACD line, the signal line, and the histogram. The MACD line is the difference between two EMAs, typically the 12-period and 26-period. The signal line is a 9-period EMA of the MACD line, helping smooth out signals. The histogram? It visually shows the gap between the MACD and signal line. When the histogram grows, momentum is strong. Let's see how these components work together to generate trading signals. One of the easiest ways to use MACD is by spotting crossovers. When the MACD line crosses above the signal line, it's a bullish signal. Momentum is shifting upward. When the MACD line crosses below the signal line, it's bearish. Momentum is weakening. But be careful. Not all crossovers lead to big moves. Always check the market trend before entering a trade. Let's look at real examples to see how these crossovers play out. The MACD histogram is a powerful tool. It visually represents the difference between the MACD and signal lines. When the histogram bars grow, momentum is strong, and when they shrink, momentum is fading. A shrinking histogram can warn traders that a trend is losing strength before a crossover even happens. Smart traders use the histogram for early signals to enter or exit trades. Let's break down how to read the histogram like a pro. Divergence is a game changer in trading. When price makes higher highs, but MACD makes lower highs, it's a bearish divergence, a warning of potential reversal. The opposite is true for bullish divergence. Price makes lower lows, but MACD makes higher lows. This tells us momentum is shifting before price changes direction. But remember, divergence alone isn't enough. Always confirm with other indicators before placing a trade. MACD is a powerful tool, but how does it compare to other indicators? Unlike RSI, which measures overbought and oversold levels, MACD focuses on trend strength and direction. Compared to simple moving averages, MACD reacts faster to price changes. And while Bollinger Bands show volatility, MACD highlights momentum shifts. The best part? You can combine MACD with these indicators for even stronger signals. Now that you understand MACD, let's explore some strategies. First, the crossover strategy. When MACD crosses above the signal line, enter a buy trade. When it crosses below, go short. Second, the divergence strategy. Spot trend reversals before they happen. Third, combining MACD with support and resistance. Trade only when price is at a key level. These strategies help filter out false signals and improve accuracy. MACD is a great tool, but traders often make mistakes. The first mistake? Trading every crossover without checking the trend. It leads to false signals. The second mistake? Ignoring divergence. It's a powerful early warning system. And finally, relying only on MACD without confirmation from support, resistance, or volume. The key to success? Use MACD with other tools for smarter trades. Awesome job, traders! Let's quickly review what we've learned. MACD tracks trend direction and momentum using moving averages. Crossovers and histograms help spot trend changes early. Divergence warns of potential reversals before they happen. Combining MACD with other indicators increases accuracy. Pipdemy is here to help you trade smarter. Keep practicing, and I'll see you in the next lesson.